Well, it's a mixture of things, Tom. Good morning. The main thing is because the Bank of Japan is in a hiking cycle. So typically at the very start of a rate hiking cycle, when you're leaving the zero lower bound, which is what Japan's been doing, the long end does sell off as markets price in a higher risk of higher rates for longer. And that's what happened with the ECB's example when they escaped QE in 2017. When they did that, you saw a big steepening in the curve in Europe. And that's been what's happening in Japan. The other part of it as well is because of the life insurance and pension funds demand for the long end being softer. That's because their liabilities are getting smaller as interest rates are rising. That's kind of the mathematics of the pension fund. And the third reason is much more higher foreign participation in Japan's long end, which isn't great to see because it does invite more volatility and speculation than previously, which was more of a domestically owned market. We've actually seen a lot of hedge funds and foreign real money move into that space.
I look, Jordan, Damien Sassower has been a huge value add. Weak Taiwan dollar, Singapore dollar even rolling over, and others. Measure the contagion of the Japanese challenge and what it means for other Pacific Rim countries, and of course, what it means for the United States.
Indeed. Sometimes when we talk about the US or Europe, we talk about the bubble. We don't think about what's happening outside that will feed through. And Japan is a clear one for that. The yen has been the carry trade funder of the past 2 decades. And that applies to the front end and also the long end. Borrowing in Japan at low rates and investing that in US at higher rates of return. Well, now domestic rates are rising in Japan. You have to have either a higher rate of return for your investment in the US, so therefore it means US fixed income will underperform and rates will go higher in the US, or you need essentially to move that money back to Japan. And you're having a mixture of both. And that's leading to the yen strength. We're looking for 138 in dollar yen by the year end, down towards 136 or lower when we get to March. And that's because of the BOJ's hiking cycle mainly. But it's also because of this de-dollarization story as well that's playing in the background. I don't want to overemphasize that de-dollarization story. It's not sell America, but what we are talking about is the rest of the world outperforming the US in the second half this year.
So, again, you mentioned the dollar, and the Bloomberg dollar index is down, almost 8% from its recent high here. It cannot seem to find a bid, while U.S. equities have rebounded most of the sell-off they saw earlier this year. What's your 6 to 12-month view of the U.S. dollar?
In the short term, I'd actually be a buyer of the dollar because I think that the trade has got a little bit ahead of itself. We're looking for 120 in euro dollar, so there's still more room to go. But we've already rallied quite significantly. And in cable, we're already at our 136 target for year end, for example. But long term, I think what we're going to see is a reaction to the tariffs in Q3 and Q4 from Japan, from Europe, and the rest of the world, including China. Fiscal stimulus will come down the pipeline, reform, in an effort to boost growth, because the US tariffs will hit the rest of the world growth. Those countries will have to respond in their own way, and that will lead to expectations of growth picking up for next year. So it's kind of a down and up for the growth outlook, I think, for the rest of the world. And that's why we have the dollar underperforming, because typically when the rest of the world does fiscal reforms and picks up, the dollar weakens in that environment. But short term, I think everybody's short the dollar. I think every guest on here will probably tell you that. There's very few out there pushing for long dollar. And we are starting to see the normal correlations of foreign exchange to interest rates picking back up. And at the moment, they say the dollar's fair value. And I just worry that everyone's got the same trade on.
Rest of world, what's the best rest of world trade right here vis-a-vis the dollar, do you think?
Well, the euro is the one which stands out because of Germany. I mean, just look at their defense sector, Rheinmetall and a few other names, just extremely outperforming other names within their sector. And that's because the German fiscal taps have been turned on. The debt brake has been reformed. So that's where I'd be looking for. Sterling, I'm less interested in. And the yen, of course, we're big payers of yen rates, and we think that the yen will strengthen.